Welcome to Business Talk and Business Tech with me, Michael Avery. And right now we're talking about retirement. Now, I know during the pandemic, just having a job and for many, making it from month to month is an achievement. But according to the Institute of Retirement Funds Africa, 2/3 of members have less than 50,000 Rand in their funds, while the Alexander Forbes Member Watch survey shows that only 5% of members on the Alexander Forbes retirement platform can afford to retire comfortably. And I recall when that number was as high as 6%. So, I mean, we're heading in the wrong direction. The system clearly doesn't appear to be working in South Africa, with so few people not contributing to a pension pot at all for whatever reasons, affordability being top of the list. And COVID has certainly cranked up the volume on that debate that we're having around whether or not our system is fit for purpose. And that debate has been ratcheted up a few notches thanks to the pandemic. I'm joined by John Anderson, Head of Client Solutions at Alexander Forbes. John, great to have you on the show. Is it time to change the model? Is it not time to teach people who are retiring to invest in a scaled down business and equip them with the tools to run that business to ensure that they continue to earn beyond their retirement years?
No, thanks, Michael. And I think you've pointed out, there definitely are challenges, and they've just been elevated, I think, with the whole COVID pandemic and the lockdown. But I think we need to go back just to have a look at the purpose of a retirement fund. And that's to help individuals save for when they're no longer able to work. So to try and give them an income in retirement. And the numbers aren't great at the moment. But I think it's quite important that we do know that in terms of savings in South Africa, retirement savings through an employer is probably the biggest portion of people's savings. Without it, people would have even less. So I think it does serve as a useful savings mechanism, but it's not effective. And a number of things are coming to the fore. So firstly, people aren't saving sufficiently in terms of how much are being contributed through those employer schemes. But the most important thing is when people leave, they're actually cashing in those savings. And the big question is whether people actually do need to have those savings when they leave, or are they, is it just being done to spend on a new car or something? And we've got some statistics recently that actually indicates that a large portion of people actually cash in their savings because that's seen as the easiest thing to do, because it's very difficult to fill in the forms, get everything done in the last month of when you resign. So actually they're doing it for the wrong reasons, and then paying tax on top of that. There's definitely about 1/3 of people that quite validly do need the money. They need it because they are financially stressed, they've got debt and a whole range of other things. But at least 2/3 are doing it just because it's the easy thing to do. So to address that, the industry together with government are trying a number of things to try and improve savings for everybody, improving communication, improving the options, reducing those options, making it easier to understand, and also introducing things like defaults so that when you leave, the easiest thing to do is just leave your money invested. And where employers and funds have put those things in place, we've actually seen quite a marked increase and improvement in the outcomes. What we now need, though, is obviously COVID didn't help. So I think that was a period of huge pressure and stress. But I think after that, now that we've dealt with COVID, I think getting people back on track and using defaults, and the more of them that use these things that are available by the industry, we will see improved outcomes, as I've indicated already. Unfortunately, though, there's no simple solution. This is a multi-decade problem, in terms of retirement. So a lot of things need to happen to make sure that we improve that overall.
On the defaults, I'm interested to get your opinion on just how effectively they are working. As you said, you are seeing signs that they are having an impact. And we know these reforms were very long in the making. They were called the McCarthy reforms after David McCarthy. He didn't really see them through. It took so long. He eventually shrugged his shoulders and went off into academia. eventually they were passed, and you've got these mandatory defaults now that if you don't select, will push you in a particular direction. It's all based on Kahneman and Tversky and behavioral economics. What kind of impact? Let me rephrase it. What kind of impact are you seeing? If you look at the numbers, that
Sure.
gives you confidence that the defaults are working.
So there's a couple of indicators to have a look at. So the first thing is that when a person joins, most people select the default contribution rate that the employer puts in front of them. So more than 90% of people choose that. So if your employer's default is set at a reasonable rate, then you know you'll already be set up. So for employers that actually start at too low a default rate, I think there's scope there to improve that, because most people opt for the default. In terms of, and obviously the COVID didn't help us now, because a lot of employers actually had to introduce zero contribution rates to alleviate financial pressure, over the last 12 months. So probably about a third of employers introduced relief measures over the last year, but more and more of them are actually, those are coming to an end, where people are going back to the default contribution rates. And as long as those are at a reasonable level, we know that because 90% of people take the default that the employer selects, that actually helps. Another interesting one is that, over the last 12 months, we've seen we saw one of the biggest drop in the market values last year. It's a huge crash because of the lockdown and the response of the market to what's happening. And most people who were in retirement funds who had defaults in place actually did nothing. And that's great, because in the unit trust industry, where people can choose, a lot of them actually selected out of equities, etc., into cash and locked in, and didn't benefit from the recovery. Now, for retirement fund members, and you can argue whether they had other things on their mind, their jobs, etc., but we definitely didn't see a big panic. We saw them stick to defaults in the retirement funds, and the vast majority of members never exercised member choice. That was very powerful, in my mind and our view, to avoid value destruction.
Yeah.
So that's a good one. And then there's so the other defaults that you mentioned is when a person resigns, funds need to put default preservation vehicles in place. And that's taken some time to embed. But where we have seen funds actually adopt not just options, but actually changed their process, meaning that that the default is, if you don't make a selection, we're going to default you into a paid up status. You can still go and, cash in your money if you do need it in future. But people are actually taking the path of least resistance, which is the easiest option is just to keep my money invested, defaulted into that paid up status. And for funds that have done that, previously the number of people that preserved was less than 10%. Now it's in excess of 50%. Wow. That's a 5 times increase in the number of people preserving because of defaults. The challenge, though, is that there's still a lot of funds that haven't yet fully implemented all these changes. I mean, they've got the options available, but they haven't changed, the end-to-end running of their funds. But that's an early sign of, some good outcomes. It doesn't change it, that everyone's preserving, but I think in reality, most people, there are people that are going to be challenged because of debt, etc. But I think a 5-fold increase in preservation rates is pretty good, and that's during the COVID period as well.
Absolutely. I mean, if that trend continues, then we start to see real impact to make a dent in one of the big issues, and that is preservation. People cashing in when they change employers, or, as you say, using it to buy that new car, or maybe fund a business venture that really should not have been funded in the first place, and rather have that retirement saving in a pot doing what it should be doing, and that should be sitting there for when you retire one day. It leads me to my next question, though, and then when you retire, what we are finding is we are living a lot longer. if you can make it through pandemics like COVID-19, which do particularly impact the elderly. But all the research seems to indicate that we are living a lot longer. Does the math still make sense about retirement? Do we need to start thinking about things differently? Maybe retire a little bit later? I mean, how do you think about longevity?
No, I think those are all really good points. And I think on the one hand, you've got longevity, and I think that's been improving over a long period of time. And despite the COVID pandemic, I think longevity is still a lot better than it was, a few decades ago. So the whole concept of retirement definitely needs a rethink. We are seeing a lot of people actually not retire fully, but they rather choose what they want to do, and they still supplement their income with something else, with work that they're really interested in. And you probably will still need that, because to actually retire early these days it's quite a challenge. The amount of money that you actually need to sustain that, very few people can actually do that. So we are seeing more people consider retiring later. Funds have actually introduced options inside the fund that you can use deferred pensions. The regulator has changed, that to accommodate, but in practice we are seeing that. So definitely, increased retirement ages. I think it's also time for employers to also look at their policies. The old policies of retiring at 60 to 65 was, it came about, more than 130 odd years ago, and actually there's a lot to be said these days of flexible work. The COVID pandemic has shown us, and part of it is flexible work options and looking at how you can use people that are older better in the workforce. And there's quite a bit of research that has come out to say that diversity in the workplace improves productivity, improves profitability. And one of the diversity measures is not just diversity by gender or by race, it's actually by age.
Yeah.
If you add someone that's a bit older into a mix with the younger individuals, it actually changes the dynamic. They've got more experience, they're a little bit more calm, and they can actually add value. So I think in the past, employers were very quick to try and early retire, retrench people close to, from the 58 years onwards. But actually, they have a lot of value these days, and most jobs these days are knowledge related. Yeah. So if you can actually pass that on and also put in place things like mentorship programs, etc., together with later and deferred retirement plans, that can help individuals because they can plan better, because they are going to need to retire a bit later. They can supplement the income, but they can also give back into the organization, as well. So there's still a lot more to be done, but I think the whole thing needs to be changed. And you probably find a hybrid that pure 100% retirement in future is probably not the way to go. It's probably partial retirement, supplementing it with something. And that's also good in your old age to keep busy, because to keep fulfilled. I think the old ways of just you retire, get the gold watch, do gardening, that doesn't apply anymore. It's new ways of work, new ways of retiring essentially these days.
It sounds like you've just described Jeremy Sampson, who is a regular on my show talking about brands, and he's never been more productive, and he should be well into retirement now. But he's adding value. He's sharing, over 5 decades worth of wisdom in the branding space with these younger colleagues. And it's, you're able to do it, as you said, in a much more flexible manner. So all of these things are really worthwhile considering. If you think that if you retire 5 years later, you're really having a doubling of impact, because you have those 5 extra years of saving and all of the cumulative impacts that has on your retirement pot as well. I want to come back to an earlier point, though, that you raised about companies providing some relief, some contribution relief, zero contribution increases or rates. How do you then get these people back into the system when employees have put their payments on hold and potentially become used to this extra income now going into expenditure every month rather than savings? Does the industry now need to go out on a campaign again to re-educate these members to get them back on the savings, the retirement savings train?
Yeah. So no, it's a good question. A lot of our clients and employers have actually had to go through this. So I think when the pandemic hit, you remember that if you join an occupational fund, everybody needs to contribute at least at a certain percentage. And I think it's formal in terms of your employment contract and signing up as part of that. And that's in the formal occupational industry. What needed to happen last year was each fund and employer had to then apply for a relief package, which essentially was applying to have their fund rules amended through the regulators, and that only applied for up to a period. Most employers and funds opted for 6 months, and then they would also, some of them asked for further extensions on that. But I think at the time when the relief was given, it was on the condition that it would be temporary. It would be for a period of, let's say, 6 months. And then closer to that time, communication was sent to individuals to actually, that relief is now no longer possible and won't be extended further. And the employer will be starting to contribute at the default. So actually, it happens by default that the employer would then start paying the contributions at the new levels. It's not a choice for individuals. And I think on the one hand, that was a benefit last year, but it's also a benefit in the sense of it automatically gets people back saving. That they don't have to opt themselves to actually increase it. I think the challenge for us now is that where people are going back saving and they were previously at a higher level and now at the lowest level, to gradually get them back, that will take time. But I think at least getting people up to the minimum that the employers, it happens automatically, and it's subject to proper communication from the funds and the employers to the individuals. So I think as long as you're with an employer, that I think most of those would be back, excepting for industries where they're still under pressure, that those relief packages have actually been extended. But I think for people that are outside the formal savings and employer savings schemes, that's where it's a bigger challenge, because that's where individuals have to themselves come back in. And there we're going to have to do, campaigns, show people the benefits of saving. But I think the important thing is before they start saving for retirement, I think what COVID has shown is it's first save for your emergency and build up a buffer of anywhere up to 6 months before you have a retirement, because it's pointless having a retirement savings, but you don't have anything for emergency. And what we have seen at employers is they're now starting to run emergency savings through their payroll together with their retirement savings, so that people can build up not just the retirement pot, but the emergency savings pot. And we know that that's very, very important. But this is going to take us some time to get back as the economy starts growing, people are less financially stressed. So yeah, I think there's still a lot of work to be done.
I do think, John, when you mention what some employers are doing when it comes to attracting the best talent to rebuild when the pandemic finally blows over and we reach that herd immunity threshold that we hope to achieve as quickly as we possibly can, depending on how quickly we can roll out those vaccines. One way to do that is to show that you are an employer who thinks of things like that, to help your employees with those kinds of extra employee benefits, to help them with their retirement planning a little bit by building up emergency funds. I think now is the time that people are really sensitized to it, because almost everyone has been impacted in some way financially by this particular crisis. Just as a parting shot, because we have run out of time, sadly, but what is your big lesson from the COVID crisis, both for employers and employees to take out of the pandemic?
Yeah, look, I think a big lesson is, I think there's benefits for both employers and employees in retirement savings and schemes that are in place with the employer. And it's quite important that they work together. So, I mean, everybody had to work very quickly together last year to make sure that relief packages were in place. There wasn't any panic, that your benefits are okay, etc. So I think having good arrangements in place where there's a lot of trust, but also being able to respond very quickly. I think those are really, really important. But I think what I've definitely taken out is that, if you've got everything with an employer that looks at everything quite proactively, most of it would have been dealt with very, very well. So for employers that don't have these things in place, it's quite important that they start thinking about this, because leaving people on their own, actually it doesn't help. So employers that had well thought through packages, well managed, I think came through this a lot better than employers that had nothing. And it's shown us that, these things are all interlinked, and people actually require the employer not just for a salary, but all the other benefits, death benefits, disability benefits, and retirement benefits. And these are all linked and need to be managed very well together. And also don't panic through the markets. Stick to good investment principles. That's another lesson we keep on learning, And don't just listen to anything that you hear.
Douglas Adams had it right all along. I mean, that is a standout for me as well. As someone who works in the financial media, it's a message we've been trying to inculcate for several years now, to see that people are not panicking through periods of extreme financial stress like we saw March 2020. I'm sure people were looking at their quarterly benefit statements and wondering what was going on, and they chose to sit tight and stay the course. Means that all of this education, all of these conversations like the one we're having now, John, are really starting to hit home, and very, very pleasing to hear that indeed. John Anderson, Head of Client Solutions at Alexander Forbes, thanks so much for your time.
Thank you, Michael.